Hi, everyone. This is Adam Thurgood of Hightower Las Vegas, and I'm joined by our senior analyst and portfolio manager, Reina Penaloba. And today we're going to talk about what we feel is happening in the markets and the economy, and we'll try to answer the question that we think is on everyone's mind, and that is there light at the end of the tunnel? And perhaps more importantly, how long is that tunnel and how long is it going to take before we're into the light? So in order to do that, we thought it would be useful to first take a step back and look at how the markets and just general economic activity have progressed so far this year. Now, when we look at what's happening with the S&P 500, obviously not a great start to the year. The market's down about 20%. That's putting us in bear market territory. And if we look at how this compares in total value terms to the COVID crash, it's actually a bigger drawdown. But that's because we had such an enormous, immense run off that bottom of the COVID crash that we ended up at pretty high valuation levels. So we've seen a bigger decline in total value, but we're still well above the values that we were at before COVID actually occurred. What's really unique about this drawdown, though, is that it's happening at the same time that bonds are performing quite poorly. Bonds are off to their worst start on record. It's an ugly environment out there for fixed income. As rates rise, bond prices go down. So this has been a challenging environment for stock bond only portfolios because both assets are going down at the same time. When you include other assets like gold, it's done much better. And so that's provided a ballast to portfolios. We'll get into that a bit more a little later. So why has this been happening? Well, it's really because financial conditions have started to tighten. This is the cyclical cost index that we look at, and it looks at things like the dollar, oil prices, rates, gasoline, what the Fed is doing. And we went from record easing as a result of what was happening in COVID to now record tightening. And when you tighten financial conditions this much, you're going to cause stress in the system. And it's eventually going to spill over into economic activity. And when we look at economic activity, one of our favorite gauges is the Purchasing Managers Index. This measures general conditions in the business environment. Above 50 is considered growing, below 50 is considered contracting. We were at very robust levels in 2021, and we've come down quite a lot. We're still above 50, but it's likely that we're headed below 50 in the not too distant future, due to some leading indicators that are pointing us in that direction. You know, when we look at new orders, for example, they have plunged in things like real estate. Interest rates go up, housing market grinds to a halt. There's not a lot of sales activity going on. And you can see this in other areas of the economy. Some areas are not that affected yet, but others are dramatically affected by what's happening. So that's where we've been. How long will it take for us to get to brighter light and greener pastures? Well, unfortunately, we think there's still some pain to come in asset markets. There are certain conditions out there that cause us to be a little bit more risk off at this point in time. One is profit margins. We're sitting really at near records in terms of profit margins. And we've had enormous tailwinds that have been pushing profit margins up for some time. You know, the tax cut in 2017 caused earnings to increase. We had a lot of deflationary forces, technology, demographics, globalization, and then COVID hit and a lot of those things started to change. Now we're feeling cost pressures. We have war, which is inflationary. We have a lot of pressures that are going to cause companies to do one of two things. They're either going to raise their prices, which is tough in an environment where real consumer purchasing power is going down, or their profit margins are going to fall. We think it'll be a bit of both, but in general, our view is profit margins are cyclical, they are mean reverting, and we need to come down from these elevated, unsustainably high profit margins over the course of the next several years, and that makes it tougher for earnings to grow robustly. And when we look at corporate profits in general, the orange line here is just general profits, the level of profits. They've rolled over. We're not seeing that yet with S&P 500 earnings for a couple of reasons. One is the biggest companies may not feel the economic pain as quickly as smaller companies. But two, there's a lot of share repurchases going on. And when you take shares out of the marketplace, that on a one-for-one basis increases earnings per share. So we do expect to see earnings at least slow down, if not decline a little bit as we head into the next couple of quarters. But the market isn't there yet. The analyst expectations are still very much in the camp that earnings will continue to rise. You can see these lines in 22 and 23, they're upward sloping. That means that analysts expect as the years go on for earnings to increase. We think those lines need to flatten, if not invert, for us to feel comfortable that the assumptions that are baked into market prices are in line with reality. And one thing that has us scratching our head here to see how it's resolved is the Fed and prior tightening cycles relative to inflation. In past tightening cycles, the Fed has been able to get the Fed funds rate, which is what they control, the short-term overnight rate, above the level of inflation. Well, today we had a 9.1% print in inflation, and the Fed funds rate is quite low. So it's going to take a lot for this relationship to reverse. Rates are going to have to go up tremendously, which would be very bad for the economy, and or inflation has to come down. Now, this may be the first cycle in some time where the Fed is actually stopped tightening before the level of the Fed funds rate has gotten above the level of inflation. They're really walking a delicate balance here because this is a unique environment where normally demand is a major component of how inflation operates, and the Fed can help to regulate demand by making financial conditions tighter or looser. And we haven't had a lot of supply issues in the past. Well, this time it's largely a supply-driven problem. And the Fed, unfortunately, or I guess fortunately, can't print oil, they can't print wheat, they can't print soybeans, they can't take care of the supply situation. It's out of their control. What they can do is try to work on reducing demand. How do they do that? Well, if we think about how the economy works, in today's world, there are two types of people: those that spend all of the money they make every month and those that save. And the ones that spend all the money they make every month, it's not going to really matter if the Fed is going to try and crimp their demand. Now, it will cause them to spend less in terms of what they would want to spend it on, because they'll have to spend more on food and energy, but there's not incremental spending going on there. Incremental spending in the economy now comes from people with assets that feel comfortable about going out and building a second home or going on a vacation or remodeling their kitchen. And the Fed is trying to curb that demand. So they've basically all but explicitly said, we need to bring asset prices down. They've gotten too high. People feel too wealthy. They're spending too much money, and we need to try and regulate that. And this has become a strange environment where the tail of the economy is wagging the dog now, where asset prices really are determinant in whether or not economic growth occurs. So the Fed is walking a very delicate tightrope here. They're trying to lower demand by increasing rates, but at the same time, that has negative consequences for economic growth. So Raina is going to get into a bit more detail about the balancing act and the inflationary pressures that we're seeing today.
Yeah, the Fed is indeed trying to keep a tricky balancing act here. They have a dual mandate. They're trying to keep stable prices while maintaining a strong labor market. And if they're really too aggressive right now, trying to tame inflation right away, well, they can then cause a really severe recession that would push the unemployment level up, and then the Fed can force themselves really to then turn around and have to ease with inflation still at elevated prices, which is going to be a total mess for them. It's going to be a mess for the markets. They're going to have to go back and forth and are very likely to try and avoid that scenario altogether. What they're probably trying to do is rather to manage demand and take it down slowly, to be able to measure and prove that inflation is indeed grounded, that it's tame and is not going to take off once again when they start to ease. And even if let's say that they do push the economy into a recession, they would try to make it one that gets there slowly and is not as deep and not as easier to get out of once they start easing again, because they don't want to spark inflation one more time when they start easing on the other side of it. So how do market participants really gauge how much room the Fed really has to tighten here? Well, we have to keep a close eye on the labor market. And something, for example, like the quits rate is a good indication of the strength of the labor market. For example, when people are feeling confident they can quit, that means they believe that they can find a better job once they do that. And currently that measure sits at a very high level, at almost all-time highs. Another indication is the job openings, which are also at very healthy level currently, but we can see that year over year, there's quite a bit of deceleration there. So some cracks starting to appear in the labor market on that measure. But overall, when you look at the unemployment rate, it's still at record low levels, and definitely no alarm bells ringing here. So we might want to also look at some more comprehensive measures. A good one that we like to follow is financial stress. It's a combination of several different metrics. It includes some the mortgage payments. It includes credit card payments, even stock market valuations. And we can see that financial stress is now indeed starting to increase in quite a bit, but is far away from any crisis level. So it looks like we have further to go before the Fed is accommodative again for markets. And it's really easy for us to think that there must be an easier way to go. Perhaps if we just increase wages, people can compensate for the higher inflation and the economy can chug along just fine. Well, it's not as easy. And the next chart really illustrates that pretty well, I think. It shows average hourly earnings, and it's been growing at about a 5.5% pace, which is pretty good, but housing prices completely outpace it. And even though average hourly earnings are growing, housing prices are becoming less and less affordable. And on top of that, for housing, we have the added pressure from mortgage rates shooting up as fast as they have. I'm sure that you've heard of that. And that had happened pretty suddenly and really by design. One of the first things that the Fed did when they started tightening was to taper down the mortgage-backed security purchases they were doing on a monthly basis. And that had the immediate effect of increasing mortgage rates. So why would they do that? Well, the housing market is very important for the US economy. It has an enormous multiplier effect. Every time we buy a house, we start purchasing all sorts of other things. Perhaps we want new furniture, we want new appliances, maybe we want to remodel the house, and this starts to trickle down throughout the whole economy. So trying to rein in the pace, at least, of those purchases is one lever the Fed is really using to manage down demand. As we discussed earlier, that would be their probably their desire. So owner equivalent rent is also connected to the housing market and is the rate that a homeowner would accept to rent out their property. It is quite sticky. It tends to follow the housing prices, and it's a major component of the inflation readings. About 24% of inflation readings are connected to owner equivalent rent. So definitely any market participant is also closely monitoring this, and it's going to be misguided to believe that just because commodity prices, for example, fall or gas prices decline, that maybe inflation is going to evaporate all of a sudden. Well, there's just a lot more moving parts to this than meets the eye at first. And again, we have even more components of inflation that keep rising. Food inflation is one. It's been on everybody's radar. Everybody felt it at the grocery store, and it has the effect of increasing living conditions, living prices altogether. So consumers are really being attacked from two different places. On one hand, their investments are declining in value, such as the stock market investments. Maybe in the future, the housing prices are going to decline, and at the same time, the cost of living is also increasing. So also the real disposable income as a result of that has declined sharply, and is really no wonder why the consumer sentiment is at such depressed levels as it is today. This is one metric that foreshadows recessions when it's at such depressed levels. So it's easy for people to feel lost in this situation. And Adam is going to walk us through what we can do to manage this.
Thanks, Raina. Yeah, it is easy to feel lost in this type of an environment. And what we think is most important right now is actually managing risk. Risk management is critical in times like this. You don't want to blow up your financial plan by going all in cash, especially when inflation is ripping at 9%. But you also don't want to close your eyes and just forget about it either. You want to make sure you have some safety precautions in place that help you work through the environment in a safe manner. I was a Boy Scout, an Eagle Scout. Be prepared, and the mottos that we learned there are true in investment management as well. You need to understand what's happening, and you need to have defense mechanisms in place in case things don't go your way. So at this point in time, we believe that it's really important to know where you stand in terms of total risk. And what we do is we dial up risk and dial down risk within a predefined range based on market conditions and economic activity. And right now we're at the lower end of that range. And we will be at the lower end until we see some indication that the environment is getting less risky. Now, another way to diversify or to manage risk is to diversify and own assets that have a low correlation to stocks and bonds. Gold happens to be one of those assets. You've heard us talk about it in prior client briefings. We're fans of gold. It's provided solid returns over the last couple of decades. It is volatile, but it tends to be volatile in its own way. And this year, it's provided a nice ballast to portfolios. It's down about 4% versus the down 20% in the S&P 500. We continue to believe that the precious metal space will benefit from when the Fed eventually puts the brakes on this tightening activity. Also, when you're going into recession, you need to know what's under the hood, even more so than in normal good times, because the skeletons tend to come out of the closet during recessionary periods. So we've spent some time, as always, diving into normalizing earnings of companies, understanding what it would mean if their profit margins reverted back to more normal levels, and how that would affect valuation. Spend a lot of time looking at company balance sheets to know just how well positioned they are and how much of a storm they can weather. If you think back to the financial crisis, the people that were levered 98% on their homes probably lost their home. The people that had 20% leverage on their homes were fine. So we want to make sure that we own companies that can survive bad times as well. And then it becomes a matter of tactical versus strategic moves. The big picture long-term thinking remains in place. When we build financial plans for you and run it through scenario analyses, bad market environments or tough market environments are included in those analyses. They're assumed that they will happen in certain circumstances. So we don't want to blow up the entire plan because we're in a tough market, but what we can do is make changes at the margin. And so what we've been doing the past couple of quarters is adding hedges when we believe it makes sense. That can be in the form of short positions that go up when the market goes down. It can be in terms of volatility positions that go up when fear rises. We've been moving around on the edges in some hedges that can help to manage the volatility in our portfolios. And really what we're focusing on in the big picture is what conditions might change that would cause us to feel more comfortable increasing risk back to normal levels. And one of the things that we're focused on is this cyclical cost index or the financial stress index. We want to see a leveling off or even a reversal in these indicators before we feel comfortable that we have a clearer path in front of us. Also, if the pressures keep rising and the Fed has to continue to fight inflation at an aggressive level, then we're probably going to need to see a bigger storm in asset prices to really crimp demand. We hope that's not the case. We hope that the Fed is willing to, see through potentially an environment where inflation might be slowing, but the trailing readings are not showing that yet. But if they aren't and they push the markets into a much more stressful situation, we are prepared with our lower risk profile and some of the hedges that we have in place to help mitigate some of the downside that we would see in portfolios. At the end of the day, though, we think that the Fed is going to pivot one way or another. We talked about the tail wagging the dog. Asset markets and asset prices have become integral to economic growth, and at some point, the Fed will have to support the economy. Now, whether that comes in the near future or whether they have to wait a bit because of inflationary pressures, that's yet to be determined. You can see a lot of different opinions on this point, but we do believe a Fed pivot is coming at some point, that they will support asset prices, but we don't know when that point will be. So in the interim, we are patiently waiting for the indicators that we're watching to turn that would give us an indication that it is now time to take on more risk, but we're not there yet. But we are keeping our eye on the ball and really focused on the level of inflation, the intent of the Fed, and how asset markets are responding to those two factors. So again, thank you for your time today. As always, you can reach us if you have any questions, and we'll see you next time. Thanks.